Picture this, you're in a windowless meeting, your boss is mid-power trip rant, and you're only half listening because your phone just pinged. The index fund you've been feeding for years quietly crossed the number that means work is now optional. You stand up, smile, and without a quiver say, "Thanks for everything," then walk out while the room freezes. That calm exit is what J.L. Collins calls FU money, enough invested cash to choose freedom over fear. In the next 14 minutes, I'm handing you the exact 9-step roadmap Collins designed for his daughter. A playbook so simple, it needs 0 stock picks, 0 spreadsheets, and almost 0 willpower. Miss one step and you'll keep guessing nail all 9. And that conference room walkout can be your Thursday morning. Ready to swap stress for a rich, free life? Let's roll. J.L. Collins wasn't born with a silver ticker symbol. He slogged up the corporate ladder until a market crash wiped half his 401k and doubled his resolve to master money on his terms. The result was his viral stock series blog, distilled into the simple path to wealth, a blueprint, proving that a single low-fee index fund can outperform 90% of Wall Street and buy you decades of freedom. Why does this matter now? Because today's news cycle screams recession one week and meme stock riches the next. Most people chase both and capture neither. Collins argues you don't need stock tips, crypto tricks, or a finance degree. You need 9 disciplined moves. Spend less than you earn, slay debt, build an FU money cushion, and automate everything into a total market index fund. Then ignore the noise until your portfolio can pay you more than your boss. If zero fluff roadmaps like this light you up, hit subscribe right now and ring the bell. YouTube often hides life-changing ideas unless you specifically ask for them. Grab a pen. Rule 1, how to weaponize your paycheck against lifestyle creep starts in 3, 2, 1. Rule 1, spend less than you earn, weaponize your paycheck. J.L. Collins jokes that every dollar has only 2 possible fates, soldier or saboteur. Soldiers march into index funds and earn you freedom. Saboteurs buy stuff that collects dust and interest payments. Early in his career, Collins earned a raise, upgraded to a status condo, and watched his bank balance stay flat until a layoff letter arrived. Panic punched harder than the pink slip. He vowed never again. Here's the fix. Pay yourself first at least 50% of every paycheck before the money even sniffs your checking account. Set an auto transfer the morning you get paid, 25% to an FU money cash buffer, 25% straight into your total market index fund. Live on whatever drips through the sieve. Micro action. Open your banking app tonight. Schedule the split for the next payday. Screenshot it and celebrate in the comments. We'll pin the boldest savings rate. But soldiers can't advance if vampires drain their blood first. Enter Rule 2, the ruthless debt cure Collins used to stake every high-interest saboteur in his life. Rule 2, debt is a vampire, stake it fast. Collins calls consumer debt a reverse index fund that compounds against you. Picture a latte-loving 22-year-old who swipes $5 daily on a 20% APR card. In 10 years, that trivial habit balloons into $22,000, enough to buy 450 shares of VTI she'll never see. Debt doesn't just slow you, it drags you backward in time. Step 1. List every balance, interest rate, and minimum payment. Step 2. Pick your weapon. Avalanche targets the highest APR first, or Snowball crushes the smallest balance for a psychological win. Collins prefers Avalanche. Research shows it saves more, but choose the method you'll stick to. Either way, funnel every spare dime, yes, even the Netflix share password, into that target until it's dust. Then roll the freed payment to the next vampire. Write your balances on a sticky note, snap a photo, and set it as your phone wallpaper. Daily accountability hurts but heals fast. Debt stake ready? Good, because Rule 3 builds the cash cushion that lets you tell any toxic boss, "I'm out," without checking the market first. Rule 3. Build your FU money cushion. In 2009, Collins watched colleagues cling to desks like lifeboats while layoffs swept through. He was calm because his savings account already held 1 year of living expenses. That cash wasn't lazy, it was a freedom shield. When a VP hinted he might be next, Collins simply replied, "I'll leave today, no severance needed." The VP backpedaled. That's FU money power before you even hit full financial independence. Your target 6-12 months of bare-bones cost parked in a high-yield savings or short-term treasury ETF. Skip fancy yield chasing, liquidity trumps decimals. Automate transfers until the cushion equals your survival budget, rent, food, insurance, and Wi-Fi for Netflix wind-downs. Research shows seeing a 5-figure cash buffer lowers cortisol and improves decision-making, meaning you'll handle market swings without panic selling. Open your Notes app, total last month's must-pay bills, multiply by 9 and write Freedom Shield, the dollar's amount. Tape it to your laptop lid. Every deposit shrinks the gap and toxic meetings already feel shorter. But cash alone won't make you rich. Rule 4 unveils the single fund that quietly beats most Wall Street hotshots while you binge your favorite series. Rule 4. Buy the whole market, VTSAX, VTI. Collins tested stock picking in his 20s. He nailed a few winners, then one dog erased 3 years of gains. Meanwhile, an ignored S&P 500 index fund chugged up 11% a year. Light bulb moment: own everything, ride capitalism, and stop guessing. His weapon of choice is Vanguard's total stock market, VTSAX in retirement accounts, VTI in brokerage. Expense ratio, 0.04%. Translation, just $40 per dollar, 100K versus the industry's typical $1,000 fee. Over 30 years, that tiny leak saves you roughly $225,000. Still skeptical? From 2000 to 2020, VTI returned about 7% CAGR despite 2 brutal crashes. In the same span, the average actively managed U.S. equity fund lagged by nearly 2 percentage points, death by 1,000 basis points. Google your current fund's expense ratio. If it's above 0.20%, imagine a vampire meter quietly draining hundreds each year. Comment on your ratio. I'll reply with how much that fee costs over 3 decades. Next up, even the perfect index won't grow if you toy with market timing. Rule 5 illustrates how automation turns every paycheck into a buy-the-dip machine, requiring no willpower. Rule 5. Automate and ignore. Turn payday into buy day. When Colin's daughter got her first job, he didn't gift her a stock tip. He gifted her an automatic transfer form. Every payday, 20% slid straight into VTSAX before she even unlocked her phone. Then he gave her a challenge. Don't check the balance for a year. 12 months later, the market had seen sawed, headlines screamed recession, and her account was up 4 figures. Lesson locked: automation beats emotion. Set it and forget it. Log in to payroll or brokerage. Route a fixed dollar amount or percent to your index fund the day your salary hits. Delete the trading app shortcuts from your home screen. Fun fact, from 1993 to 2022, if you missed just the market's best 10 days, your total return was cut in half. Automated buyers never miss those days because they're always in the game. Schedule your auto invest tonight, then move the brokerage app to a hidden folder titled Open Quarterly. Screenshot the confirmation and flex in the comments. Best automation win gets pinned. Automation shields you from your feelings, but bear markets still spook the bravest investors. Rule 6 illustrates why time in the market outperforms timing the market and how crashes can become opportunities, not catastrophes. Rule 6. Time beats timing. Profit from market panic. In 2008, Collins watched the S&P 500 plunge 37%. Friends bailed, locked in losses, and vowed never to return. Collins continued to buy every 2 weeks, maintaining the same dollar amount. By 2013, his balance had doubled from the bottom, while the panic sellers were still waiting for a safe entry. Zoom out, a rolling 30-year view of U.S. stocks has never posted a negative return. That's wars, bubbles, pandemic, yet the line trends inexorably up. Timing feels smart. Time is undefeated. Reframe crashes. A 30% drop is a 30% off sale on future freedom. The only way to guarantee you capture the rebound is to own shares already when it starts. Media noise. Collins suggests a detox. Check markets once a quarter on the same day you rebalance, then log out. Google S&P 500 historical chart, switch to the max view, and note how tiny each crash looks. Set that image as your phone background to inoculate against the next doom headline. Coming up, you know the mindset. Now calculate the exact dollar target that lets you clock out for good. Rule 7 reveals the 4% rule and your PI number. Rule 7. Your FI number, the 4% rule. Collins once asked a room full of new grads, how much money buys freedom? Answers ranged from $1 million to I have no clue. He clicked on a single formula, Annual spending multiplied by 25 equal to FI number. Because withdrawing 4% of that nest egg each year, the Trinity study, 95% success over 30 years, covers your bills. Example, live happily on 40K, 40,000 multiplied by 25 equal to $1 million. Prefer a $60K lifestyle? You're shooting for $1.5 million. That's it, no Ouija board, no CNBC ticker crawl. Here's the kicker. Every $100 you trim from yearly expenses lowers your FI target by $2,500. Cut a $200 cable bundle, and you just shave $5,000 off the freedom price tag. With instant leverage. Open notes, write last year's after-tax spend, multiply by 25, and circle the number. Drop your target in the comments. I'll pin the boldest or leanest FI goal and break down how long it could take at different savings rates. Great, you know the finish line. But sprinting full steam into retirement can turn a bear market into a mauling. Rule 8 shows how to glide safely from 100% offense to a sleep-at-night mix. Rule 8, shift gears for drawdown. From 100% stocks to an 80-20 mix. Collins met a couple who reached their $1.2 million financial independence target in 2007, every dime invested in stocks. When 2008 carved that balance to $700K, they stapled resumes together and unretired through tears. Sequence risk can destroy dreams if you reach retirement fully exposed. Here's the 3-step glide path that fixes it. 1. Accumulation mode. While paychecks flow, stay at 100% in a total market index fund. Growth matters more than bumps because decades are your shock absorbers. 2. Pre-retire mode. 2 to 3 years before quitting, dial back to roughly 90% stocks and 10% bonds. That slim bond sleeve starts absorbing volatility without throttling momentum. 3. Drawdown mode. Once you stop working, settle at about 80% stocks and 20% bonds. Bonds Collins favors Vanguard's VTSAX or short-term treasuries, as they won't turbocharge returns, but they buy sleep and fund withdrawals when stocks are on sale. Rebalance yearly if stocks balloon to 85%, trim and refill bonds. If they crater to 70%, sell bonds to scoop up discounted shares. Build a mock 80/20th portfolio in your brokerage and backtest it for 5 years. Screenshot the smoother ride versus all stock and drop it below. The best chart gets featured in the community tab. Up next, the final rule guarantees your wealth outlives you and levels up the next generation. Buckle up for Rule 9, generational wealth done right. Rule 9, pass the torch, generational wealth, minus the spoiled kid syndrome. J.L. Collins reminds his daughter that the goal isn't piling up cash for a Viking funeral inheritance, but rather handing off skills and structures that let the next generation grow wealth without entitlement rot. He calls it the teach then fund model. 1. Money talks early. Involve kids when you rebalance. Show them how $100 grows in an index fund compared to a toy that ends up in a landfill. 2. Custodial Roth IRA. Any teen with earned income can stash up to $7,000 2025 limit into a Roth. Start at 16, and they could see $1 million by 65 even if they never add another dime. 3. 529 or Junior ISA. Use low-fee index options so college savings compound instead of fee bleed. 4. Don't raise money idiots. Rule. Make every cash gift conditional on reading one finance book or summarizing a blog post. Knowledge before dollars. If you have kids or nieces, godchildren, grandkids, open a shared Google Sheet titled Money Lessons. Add one column. Date lesson, dollar amount. First row tonight, why index funds beat stock picking, $10 quiz reward. Screenshot it and drop it below. I'll highlight the most creative lesson in a future short. A 1% advisor fee may seem tiny, but over 40 years it can consume 1/3 of your returns. Comment with the worst fee you've ever paid a bank, fund, or advisor, and I'll reply with what that fee would cost over 3 decades. Smash like if you're done tipping vampires. Here's your condensed flight plan for 9 checkpoints to a rich, free life. 1. Pay yourself first power. Siphon 50% of every paycheck before lifestyle creep smells it. 2. Stake the debt vampires. Highest interest first, no mercy. 3. Fuel up cushion, 6 to 12 months cash. So any toxic boss loses leverage. 4. Own the whole market, one low-fee total stock index fund, forever. 5. Automate and ignore, let code buy dips while you sleep. 6. Time beats timing, crashes equal coupons. Stay strapped in. 7. 4% rule, FI number minus annual spend. Multiply by 25 equal to freedom price tag. 8. 80/20 glide path. The cane bods before you hit quit. 9. Teach, then fund, past skills first, money second. 24-hour action challenge. Schedule your auto invest, list and rank your debts. Calculate your FI number and comment on it below. I'll spotlight the boldest goal. What next? Level up your mindset to stay committed to your plan. Grab The Psychology of Money by Morgan Housel, a masterclass on the emotions that make or break long-term investing. The link to our summary is in the description. Like the No BS path, smash like, hit subscribe, ring the bell and share this with a friend still stock picking memes. Your simple path starts now. The market opens tomorrow whether you act or not.